Darwinex 0 is known for doing things as well as possible, or at least trying to. And when it comes to measuring risk, there's something we need to be clear about. Drawdown does not measure the risk of a strategy. Drawdown only tells us what losses that strategy has suffered in the past. Risk is uncertainty. Risk is the probability of suffering losses, not a fixed value. Before moving on to more complex concepts within the industry during the calibration phase, this is what Darwinex 0 does: measure or calculate the risk of your strategy. And for that, we'll need to trade for a minimum of 15 trading days and make 25 trading decisions. This, by the way, has changed over time, which is why in the previous video I gave different figures. But what are trading decisions? Are they trades? Are they positions? Let's take a look. Disclaimer, and let's begin. Even though this might seem very basic, it never hurts to refresh and reinforce concepts. So in this brief explanation we'll go over the differences between orders, trades, positions and trading decisions. Let's look at what trading decisions are very quickly. Very simple. And for that we're going to draw a vertical axis and a horizontal one. We'll call the y-axis number of trades. We'll call the x-axis time. An order is an instruction we send to the broker indicating what we want to do in the market. We may want to buy, sell, open, close. These are our instructions, which nowadays we execute ourselves directly through the trading platform. Right, let's imagine we want to open a trade on the Nasdaq 100 as a buy. We send our buy order and after a day we close it with another order. That's a trading position made up of a single trade in which we are taking on a specific risk. But let's go back. We open an order. We open a trade on the Nasdaq 100 as a buy and after a day, instead of closing it, we send another buy order on the SP 500, also a buy, with a different order. In this case we have a trading position made up of two trades assuming a different risk than in the previous scenario. Specifically, we'd be increasing the risk. We could even say we're doubling the risk we've taken, as both assets we're exposed to are highly correlated, meaning they move practically at the same pace and in the same direction. The next day the market moves in our favor and we believe it should pull back a bit, but to avoid closing our position we hedge by opening another trade in gold, which is uncorrelated to the other two indices. We send another buy order in gold and in this case we'll have a different position made up of three trades, but now the risk is also different. It's slightly lower than before, since this third asset is uncorrelated. The next day the market stays flat and we want to reduce our exposure a bit more, so we close the SP 500 trade, keep the Nasdaq and gold trades open. Again, a different position made up of two trades with a different risk. Before we finish, let me remind you that if you haven't signed up to Darwinex 0 yet, below in the video description and in the pinned comment you'll find the links with the discount already applied: 20% off the monthly plan and an additional 5% for the 1 and 3 year plans. Finally, let's say the Nasdaq is now ready to go back up, so we close the gold trade and keep the Nasdaq trade open for another day, leaving us exposed to the market with a position made up of a single trade with a different risk to the previous ones, until we eventually close it. As you can see, an order, a trade and a trading position are not the same thing. How many trading decisions are there in this period? Each instruction or order we send to the market is a trading decision we're making where exposure and risk change depending on the size of the resulting position from all the trades, depending on the assets selected, whether they're correlated or not, depending on the volatility of each of them at any given moment. Therefore, in this case we would have made a first, second, third, fourth, fifth and even sixth trading decision. And we'll need up to 25 to calibrate our Darwin. I hope you found it useful. Now yes, in this video we're going to take a closer look at what VAR actually is. See you in the next one.